Hey guys, Stockaholics, thanks for being here today. Containership stocks are overvalued. I've been following the tanker space for a while now, and I've learned a lot about a lot of patterns in the overall shipping industry. In this cycle, which we are in now for container ships, I have been learning a lot and observing this space over the past several months. And based on a lot of the patterns I already know from shipping, I've come to this conclusion in this video today. I wouldn't make a bearish video on this if I didn't have a high level of conviction, and I'm going to be talking about why I think container ship stocks are overvalued. I don't have a short position, and I won't be taking a short position. I only go long, but I wanted to share my thoughts. And I know this is probably not going to be a popular opinion, but that's okay. I'm going to make it anyway. And I am open to criticism. So if you would like to tell me why I'm right or why I'm wrong in the comments, I would love to hear it. All shipping segments are highly cyclical, container ships included. What I have here is a picture of the business cycle, and this relates tremendously to how shipping kinds of works, right? And one of the ways you can think about this cycle is especially in terms of earnings or the rates that ships receive. So I think right now, I don't know the exact point we would be on this cycle, but I would suggest that we are somewhere over here, right? When rates are very high, like they are now, it leads to changes that take place where they ultimately cause rates to go low. And I'm going to talk about what that is, especially later on in the video. But the main thing that is right now is when the rates are very high, it causes there to be low amounts of scrapping in the industry, and then it also leads to very high amounts of orders, which I'll show you guys a little bit later. Now, what ultimately drives share prices in shipping are earnings. So if there are very high earnings, share prices go very high. When those turn, though, share prices have there's a lot of downside. We'll just say that. Now, I've made an hour-long video on how to think about cyclicals, and I'll post a link somewhere below if you are interested in that and investing in any cyclical space profitably. We're going to start with a quote from Peter Lynch. "You make the most money in cyclicals when earnings go from rotten to mediocre, or from mediocre to pretty good. The danger point is when earnings go from great to spectacular." Okay, on my screen here I have a graph to kind of visualize how crazy container ship rates have gotten. These are two routes, Shanghai to Los Angeles and Shanghai to Rotterdam. Although there's only two routes listed on this graph, there you can look at all kinds of other graphs out there, and every route has just insanely high rates. Yeah. So on these two routes, though, we can look for past several years. The rates kind of hovered around the 2000 mark, but over the last year or so, the shipping rates have gone 6 or 7-fold. So I think to categorize the rates for container ships as anything other than spectacular would be pretty hard. And to kind of show you how those rates correlate to share prices, I have this graph here. This is a shipping company that delivers goods to where I live in Hawaii called Matson. I actually thought about buying this company early in the pandemic, but I didn't. So, well, next time, all right? So what you can see here is that the share price has just absolutely exploded beyond any reasonable measure over the lifetime of this company. It's absolutely crazy. But if any experienced investor knows, when you see these kinds of hockey stick patterns, they usually should trigger some alarm bells for investors. Okay, I'd like to explain what's been driving container ship rates and why I think that this is a transitory event. It's not likely to continue much longer. What I have here is taken from the FRED, and this is the personal consumption expenditures of durable goods. Okay, and what this is showing us is American consumption of durable goods. And usually during periods of economic expansion, there's a pretty linear relationship here, right? As time goes on, Americans have been buying more and more stuff. And during recessions, Americans have been buying a lot less stuff, right? Now, during the pandemic or over the last year or so, something absolutely crazy has been happening, right? And what I'd like to say is, if you look at this chart, this is not a normal level of consumption, okay? Americans bought a tremendous amount of durable goods over the last year as the economy opened up and Uncle Sam poured stimulus money on everyone. In 2020, the average income of Americans increased substantially compared to the years prior to this. So what I believe this stimulus has led to, along with a lot of Americans not being able to travel, it led to just an absolute increase in goods purchases instead of services expenditures. And at the same time, they had higher than average income. So the amount of durable goods being purchased went absolutely haywire. And that's led to a tremendous amount of demand for container ships. When you think about a lot of world trade, where do a lot of the goods that Americans purchase come from? Well, they come from the Far East. Okay, but here's the thing. Once durable goods are purchased, they're already purchased. So at the beginning of the pandemic, for example, I bought a web camera and started my YouTube channel. And since then, I haven't gone out and purchased another web camera. I haven't had a need to do that because I've already got that web camera, right? If the same thing is true for all of these kinds of durable goods that can be purchased, whether that be appliances like on this chart or any other kind of a durable good, right? If everyone has purchased durable goods, a lot, especially if that's a lot of that has come from stimulus money, they don't need to go out and purchase another one, right? So if you see a tremendous amount of purchases all at once, that most likely means that in the near future, the price of those, or sorry, the amount of those goods being purchased is very likely to shrink dramatically. I would expect that the graph that we saw prior, the amount of these sales at least reverts to the mean, where we see that linear growth in terms of sales again, unless we start to see more stimulus, right? But I think that's increasingly unlikely as time has gone on, yeah? And there's another part to that too. And when these shipping rates get very high, that increases the price of goods, right? When this microwave, could be transported to the United States very cheaply before, that shipping cost was negligible in the overall price of the good. But when you have to pay 4 or 5 or 6 times as much to get that microwave across the ocean into the United States, then the cost that end customers have to pay to purchase that go up dramatically, right? So if we combine the fact that a lot of people have already purchased their durable goods, and the price of these goods is likely to have to go up dramatically to compensate for those shipping costs, and that further stimulus is unlikely, that means that it is very likely that a dramatic decrease in durable goods sales is coming. So the cure for high prices is high prices. As container ship rates skyrocket, the cost of goods go up. Sellers will attempt to push this cost to the consumer. Because consumers have already purchased so many durable goods and because prices are going up so rapidly, I expect the consumer to reject high prices without further stimulus. Okay, but there's two sides to the equation. There's not only the demand side that we need to consider, but there is the supply side. And over the past year, shipping has been a nightmare in terms of containers getting from point A to point B. And the main reason for that is, I think, as many of us know, is the virus that cannot be named. The spread of this disease has been very difficult for ports. You can think about what goes on at ports. There's a lot of international travel happening, and there's a lot of human capital, people that work at these ports, right? They don't want to contract the disease, and they want to stay safe. So that has led to a lot of disruptions with onshoremen and these types of people at the ports. At the same time, there has been infections on the ships themselves, right? So if there is a portion of the crew that has contracted COVID, that has also led to a lot of these ships being stranded at sea, right? So you take these two things and you put those together, it is just been it's been very difficult for these types of cargo, right? Now, earlier this year, there was, on top of that overall disruption, there was another big disruption that led to even more bottlenecks. And the bottleneck that was created with the Suez Canal blockage earlier this year exacerbated these problems. And these problems take a while to run off. So when there was both the COVID issue and then the canal was blocked for a few weeks, the rates have just gone up and up and up, right? But there's two things, right? These supply disruptions, they can only last so long, right? The Suez Canal is no longer blocked, and a lot of the world, especially in these Western economies and these high-risk areas with these kinds of onshoremen types of people, have access to vaccines, right? So it's only a matter of time before these kinds of supply disruptions alleviate themselves. I've also read somewhere that there has been an issue with these containers on the ships themselves. With as much of this unbalanced trade that we've seen because of the American stimulus, where people are going out and purchasing goods, there's been a lot of imbalance with these containers. There are points where there's not enough containers, and there are points when there's too many empty containers, right? So one of the things I've also noticed is that in China, where there are a lot of these points of not enough of these vessels, or not enough of these containers, they are absolutely ramping up the production of these things, right? There's a lot of demand for these containers, so they're building a lot of them. And that is another sign that these supply disruptions are likely coming to an end. I wanted to show you guys this company. This is not a container ship company, but I wanted to mention it anyway because I think it's important to kind of counter an argument that I've heard with a lot of container ship bulls, and that is that a lot of container companies are locking in long-term contracts. Okay, so in some cases there are some container ship companies perhaps anticipating that at some point the market will turn. They are locking in charter rates for as long, in some cases, as 5 years out. Now, if you were interested in investing in container ship companies, in my opinion, these would be the kind of companies you would look for. But unless that company's fleet has 100% or so of these contracts locked in, when the market turns, the ships that are not on contract are likely to be losing money. In any case, I wanted to show you DHT Holdings. This company in the first half of 2020 made a killing, just like a lot of other oil tanker companies out there when there was the oil contango that took place. But what this company did, which was a little bit different than a lot of their peers, is that they contracted charters out as well, long-term charters. And that caused them to be profitable for the back half of 2020 and have higher earnings than a lot of their peers, even to this day, right? But you'll notice that during that peak, when there was a dramatic excitement, even though they had locked in those long rates for a long period of time, the share price is significantly lower than when there was a lot of market euphoria. Yeah. So I would like to point out that a lot of those people who think that because your container ship company may be locking in long-term rates means that there's no downside, I would have to completely disagree. When the market sentiment turns, it doesn't matter unless they've locked in perhaps 100% of their fleet on these long-term charter rates. The share price will go down when the market turns. This is where things get scary, right? So when shipping companies are making tons of money, what they always do is they go out and they buy new ships, right? And that is what we have seen dramatically in the past couple of quarters. So these are the container ship orders by quarter over the last 5 years. And you can see that it generally falls in a certain range, right? But over the last couple of quarters, they have gone bananas in ordering ships. And I'd like to mention this is going to continue. As rates stay high for long periods of time, I would expect in the next quarter to see even higher amounts of orders, okay? So what that means is at some point a few years down the line, all of these vessels are going to be hitting the water at the same time. And that's going to lead to an oversupply of ships. And because a lot of investors are forward looking, when they realize that rates have turned and they realize what the order book looks like, there's only one way for share prices to go when things change. And that's because the outlook, the future outlook, when things turn, are going to be very bad for a very long period of time until an excess supply of these container ships are removed from the market. Okay, so in summary, demand artificially high. There has been the COVID-induced lockdowns over the last year, and then tremendous amounts of stimulus. People were less likely to purchase services and more likely to purchase goods over the last year. That's changing. Supply has been bottlenecked temporarily. It's been because of COVID issues at ports, but we have the vaccine and that's been rolling out. It's been because of the Suez Canal blockage that exacerbated problems. That has been resolved. And there's been issues with the containers themselves. And that is slowly being resolved as China ramps up the production of these things, right? Third part, high prices, they're going to be rejected eventually, right? When we notice that so many people have bought durable goods, and the prices of those are likely to go up dramatically, there's going to be a period where their sales of durable goods go down without further stimulus, right? And the fourth reason that things look pretty bleak to me is that the tremendous amount of new buildings that we have seen are going to make the container ship market look terrible for many years to come. Now, what's interesting though about this dynamic, this actually makes me, it's actually a kind of a bullish condition for oil tanker companies out there. When you see such a tremendous amount of ordering of these new vessels of container ship, there's only so many kinds of the ships that can be produced at any given time, right? So with all of these new buildings filling up these yards in Korea, Japan, China, if and when the oil tanker market turns, that is going to put a damper on when those oil tankers can be delivered because of all the damn container ships being built. In any case, I'd like to hear some of your guys' thoughts. I know this has been extremely bearish video, and I am definitely a container ship bear, but I'd be happy to hear what your guys' thoughts are on the matter. In any case, I will see you guys soon.